The Reserve Bank itself is also playing a role in building that bridge to the recovery, and I'd now like to turn to the role we're playing. Our major focus is to support jobs, incomes and businesses so that when the health crisis does recede, the country is well placed to recover. Supporting small businesses over coming months is a particular priority for us. Prior to today's announcement, we had taken several steps over recent days to support the Australian economy. Over the past week or so, we've been injecting substantial extra liquidity into the financial system through our daily open market operations. As part of this effort, we'll be conducting 1 month and 3 month repo operations each day. We'll also conduct repo operations at the 6 month maturity or longer, at least weekly, as long as market conditions warrant. And as a result of these liquidity operations, the exchange settlement balances at the Reserve Bank have increased from around $2.5 billion a month ago to around $20 billion today. The Reserve Bank also stands ready to purchase Australian government bonds in the secondary market to support the smooth functioning of that market. The government bond market is a key market for the Australian financial system because government bonds provide the pricing benchmark for many financial assets. Our approach here is similar in concept to our long-standing approach to the foreign exchange market, where we have been prepared to support smooth market functioning when liquidity conditions are highly stressed. And we now stand ready to do the same in the Australian bond market, and we're working in close cooperation on this with the AOFM. In addition to these previously announced measures, today's package has 4 elements. These are a reduction in the cash rate to 0.25%, a target of 0.25% for the yield on 3-year government bonds, a term funding facility to support credit to businesses, especially small and medium-sized businesses, and an adjustment to the interest rate on accounts that financial institutions hold at the RBA. I'd like to discuss each of the elements of the package. The first element of the package, as I said, is a reduction in the cash rate to 25 basis points. This brings the cumulative decline over the past year to 1.25 percentage points. This is a very substantial easing of monetary policy, which is boosting the cash flow of businesses and the household sector as a whole. It's also helping our trade-exposed industries through the exchange rate channel. At the same time, though, low interest rates do have negative consequences for some people, especially those relying on interest income. The Reserve Bank Board has discussed these consequences extensively over the past year, but the evidence is that the lower interest rates do benefit the community as a whole, although I acknowledge the effects are felt unevenly. With this decision today, the policy rates of the Reserve Bank of Australia, the United States Federal Reserve, the Bank of England and the Reserve Bank of New Zealand are all effectively at 0.25%. Each of us are using all the scope that we have with interest rates to support our economies through a very challenging period. At its meeting yesterday, the Board also agreed that we would not increase the cash rate from its current level until progress was made towards full employment and that we were confident that inflation will be sustainably between 2% and 3%. This means that we are likely to be at the current level of interest rates for an extended period of time. Before the virus hit, we were expecting to make progress towards full employment and the inflation target, although that progress was expected to be only quite gradual. Recent events have obviously changed the situation, and we are now likely to remain short of our objectives for somewhat longer. I'm not able to provide you with an updated set of economic forecasts. The situation is just too fluid. But we are expecting a major hit to economic activity and incomes in Australia that will last for a number of months. We're also expecting significant job losses. The scale of those losses will depend upon the ability of businesses to keep workers on during this challenging period. We saw during the global financial crisis how flexibility in working arrangements limited job losses, and this benefited the entire community. And I hope the same is going to be true in the months ahead. It's also important to repeat that we are expecting a recovery once the virus is contained. The timing and strength of that recovery will depend upon how successful we are as a nation in building that bridge to the other side. When the recovery does come, it will be supported by a low level of interest rates. We will maintain the current setting of interest rates until a strong recovery is in place and the achievement of our objectives is clearly in sight. The second element of the package is a target for the yield on 3-year government bonds. Over recent decades, the Reserve Bank's practice has been to target the cash rate, which forms the anchor point for the risk-free yield structure. We're now extending and complementing this by also targeting a risk-free interest rate further out along the yield curve. In particular, we're targeting the yield on 3-year Australian government securities, and we've set this target at around 0.25%. It's the same as the cash rate. Over recent weeks, the yield on 3-year AGS has averaged around 0.45%, so this target represents a material reduction in bond yields. We've chosen the 3-year horizon as it influences funding rates across much of the Australian economy, and it's an important rate in financial markets. It's also consistent with the Board's expectation that the cash rate will remain at its current level for some years, but not forever. To achieve this yield target, we'll be conducting regular auctions in the bond market, and we published some technical details earlier today. We'll keep the market fully informed of our intentions. Our first auction will take place tomorrow. As part of this program, our intention is to purchase bonds of different maturities, given the higher level of substitutability between bonds across the maturity structure. We're also prepared to buy semi-government securities to achieve our target and to help facilitate the smooth functioning of the Australian bond market. I want to make it clear that our purchases will be in the secondary market, and we will not be purchasing bonds directly from the government. I'd also like to emphasise that we are not seeking to have the 3-year yield identically at 25 basis points each and every day. There's some natural variation in the market, and it doesn't make sense to counter that. It also may take some time before yields fall from their current level to 25 basis points. I understand why many people will view this as quantitative easing or QE. This is because there is a quantitative aspect to what we're doing. Achieving this target will involve the Reserve Bank buying bonds and an expansion of the Reserve Bank balance sheet. But our emphasis is not on the quantities. We're not setting objectives for the quantity and timing of bonds that we'll buy, as some other central banks have done. How much we need to purchase and when we need to enter the market will depend upon market conditions and prices. Rather than quantities or the size of our balance sheet, our focus is very much on the price of money and credit. Our objective here is to provide support for low funding costs right across the Australian economy. By lowering this important benchmark interest rate, we will add to the downward pressure on borrowing costs for financial institutions, for households, for businesses and the government. We are prepared to transact in whatever quantities are needed to achieve this objective. We expect to remain this target for 3-year yields until progress is made towards our goals of full employment and the inflation target. Our expectation, though, is that the yield target will be removed before the cash rate is increased. The third element of the package is a term funding facility for the banking system, with support for business credit, especially to small and medium-sized businesses. This scheme has two broad objectives. The first is to lower funding costs for the entire banking system so that the cost of credit to households and businesses is low. In that regard, it will complement the target for 3-year government yields that I just spoke about. The second objective is to provide an incentive for lenders to support credit to businesses, especially small and medium-sized businesses. This is a priority issue for us. Many small businesses are going to find coming months very difficult as their sales dry up and they support their staff. Assisting small businesses through this period will help us build that bridge to the other side when the recovery does take place. If Australia has lost lots of otherwise viable businesses through this period, making that recovery will be harder and we'll all pay a price for that. So it's important as a nation we address this. Under this new facility, authorised deposit-taking institutions will have access to at least $90 billion in funding. They will be able to borrow from the RBA an amount equivalent to 3% of their existing outstanding credit to Australian businesses and households. And they'll be able to draw on those funds up until the end of September this year. Lenders will also be able to borrow additional funds from the RBA if they increase credit to business this year. For every extra dollar they lend to large businesses, lenders will have access to an additional dollar of funding from the Reserve Bank. But for every extra dollar of loans to small and medium-sized businesses, the ADIs will have access to an additional $5 from the Reserve Bank. These funds can be drawn upon until the end of March next year. There's no extra borrowing allowance for additional housing loans. The funding from the Reserve Bank will be for 3 years, and it will be at a fixed interest rate of 0.25%. That's substantially below lenders' current funding costs. Institutions accessing the scheme will need to provide the usual collateral to the Reserve Bank, with haircuts applying, and the first drawings will be possible no later than 4 weeks from today. The scheme is similar to that introduced by the Bank of England. Unlike the Bank of England scheme, though, the interest rate is fixed for the term of the funding. This is consistent with our view that the cash rate is likely to stay at its current level for some time. Another difference with the Bank of England scheme is that we have not included a higher interest rate if credit contracts over the next year. While a decline in credit would be highly undesirable, we thought that including a penalty rate could act as a disincentive for institutions to take part in the scheme. We're strongly encouraging all ADIs to use the term funding facility to support their customers. In this regard, I welcome APRA's announcement this afternoon that it supports ADIs using this scheme. And I also welcome the Australian Government's announcement that it will support markets, or the market for asset-backed securities, through the AOFM. This support is important as it will help non-bank financial institutions and small lenders continue to provide credit to Australian households and businesses. The final element of the package is an adjustment to the interest rate on exchange settlement balances. Under our long-standing framework, we operate a corridor system around the cash rate. Under that system, the balances that banks hold at the RBA overnight in exchange settlement accounts earn an interest rate 25 basis points below the cash rate. And on the other side of the corridor, in the event that a bank needed to borrow from the RBA overnight, it would be charged an interest rate 25 basis points above the cash rate. Under this arrangement, and with the cash rate now at 25 basis points, the interest rate on exchange settlement balances would have been at 0. We've decided to increase this interest rate to 10 basis points. We're not making any changes to the top of the corridor. This adjustment to the corridor reflects the fact that there will be a significant increase in the balances in exchange settlement accounts at the Reserve Bank due to the combined effect of our enhanced liquidity operations, our bond purchases and our term funding program. Maintaining a 0 interest rate on these balances would increase the cost of the banking system. We judged that in the current environment that would not be helpful. The increase in settlement balance is also expected to change the way that the cash market in Australia operates. In other countries, where there have been large increases in balances at the central bank, the cash rate equivalent has drifted below the target and transaction volumes in the cash market have declined. I think it's likely that we'll see the same outcome in Australia. So the Reserve Bank will continue to monitor the cash market closely, and it's prepared to adjust these arrangements if the situation requires. So these are the 4 measures announced earlier this afternoon. Together they represent a very comprehensive package to lower funding costs in Australia and to support the provision of credit. Complementary initiatives by APRA and the AOFM are also working towards these same objectives. The term funding scheme and the 3-year yield target are both very significant developments, and they would not have been considered under normal times. They both carry financial and other risks for the Reserve Bank, and they both represent quite significant interventions by the Reserve Bank into Australia's financial markets. So the Reserve Bank Board did not take these decisions lightly. But in the context of extraordinary times, and consistent with our broad mandate to promote the economic welfare of the people of Australia, we are seeking to play our full role in building that bridge to the time when the recovery does take place. By doing all that we can to lower funding costs in Australia and support the supply of credit to business, we will help our economy and our financial system get through this difficult period. Thank you very much for listening.